Hello and welcome to the midweek edition of Targets and Focus. Joining me on the line to discuss his forecast for a host of commodity currencies is Andrew Grantham from CIBC World Markets based in Toronto. Now Andrew, the US dollar has pulled back from recent highs as fears that QE tapering also meant earlier rate hikes subsided. Given that tapering is essentially a signal of stronger US economy, do you think we will subsequently see a resurgent greenback?
I think we will, yeah. Our forecast is for the US dollar to strengthen against most of the currencies that we have forecasts for. And as you said, that's basically because we do see stronger US growth next year and towards the end of this year as well, actually. And we have seen recently that stronger US numbers are still supportive of the greenback. Now, kind of how much the US dollar strengthens against various different currency pairs is going to depend on exactly what pairs we're looking at. So we're looking for it to strengthen a bit more against the likes of the yen, the euro, and sterling in particular, because they're the ones that we see the US growth being well ahead of growth in those regions, and also due to monetary policy in Japan. We see economies linked more closely to US growth, specifically the Canadian dollar and maybe even the Mexican peso, faring a bit better than those other currencies.
Among the commodity currencies, I understand you believe the CAD is the best positioned to benefit from a stronger US growth next year, and as such, you continue to favour the loonie over the Aussie dollar. Could you tell us a little bit more about your outlook for these two against the US dollar moving forward? Yeah,
so we have the Aussie dollar actually falling slightly further. We actually have in 12 months' time, we have a forecast of 0.85 for the Aussie dollar. And what we basically are saying is that Australia and if you compare that with Canada, they're still in a very different part of their interest rate cycle. There's still scope for further rate cuts, we believe, in Australia because the domestic economy there is looking rather sluggish at the moment, and that's partly because the commodity price and the investment in commodities, which was driven by the strong Chinese growth, just isn't quite there anymore. And also we have the fact that we do see the acceleration in US growth being bigger than the acceleration we expect in Chinese growth next year. So China is going to stabilize but not accelerate as much as the US. And given that Canada's exports are tied a lot more closely to the US, Australia's exports tied very closely to China, we see that being a benefit for the Canadian dollar versus the Aussie dollar. According
to CIBC's recent publication, you continue to anticipate a gradual appreciation in the Norwegian krone in the upcoming months as the blowout above 8.0 becomes something of a distant memory. What will be the main factors driving the NOK, and do you have a figure in mind for it versus the euro around the 12-month mark?
Yeah, in 12 months we have that euro NOK going down to about 7.4. So we have the krona kind of appreciating a bit more. We do believe that when it did move above 8, that was because we had some kind of dovish signals from the central bank there, suggesting that maybe rates could be lowered. Now we've seen some better data recently. Those rate expectations have actually reversed, and so that's helped to strengthen NOK against the euro. That's trend lower in euro NOK has kind of petered out a little bit recently because we've also had some upside surprises in terms of the euro data. But we do expect that trend to re-establish itself, and that's mainly because we see a stronger Norwegian economy than we do in the euro area, and obviously we expect Norway to be raising rates quite a long way ahead of the ECB.
Andrew, thank you so much for sharing your outlook with us. Well, viewers, that's all for just now, but the TV has many more exclusive interviews to bring you today, including economic updates on Indonesia, Finland and Detroit. Goodbye for now.